Gerald is a designated seniors mortgage professional by Pivotal Aging Innovations, Inc., which is part of the same group that I'm involved in. I'm with Pivotal ASA, which is the accredited seniors agent. So I didn't realize that, Gerald. We have something to talk about later. He's also certified in reverse mortgages and licensed. He's a licensed mortgage agent. So hopefully he's going to talk about reverse mortgages, because I get inquiries and questions all the time from my customers and clients about reverse mortgages and financing. Gerald has enjoyed a 40-year career in retail banking, investing, and finance. He's an experienced investor in real estate and technology. He's part of the Fellow of Institute of Canadian Bankers and recipient of their Gold Medal for Academic Excellence. He's a recipient of the Queen's Jubilee Medal for his work with youth, and Scotiabank Chairman's Club awarded to top managers globally. So Gerald's got a lot of experience, and I welcome him to the front, and let's hear what Gerald has to say.
Thanks, Max. So for housekeeping, if you don't have a folder, there's a detailed presentation in there that in particular talks about some of the Pacific research that I'm speaking to, but before we get our slides up, we're going to speak about three things today. First of all, financial trends in retirement. Number one. Number two, some financing alternatives. And we're going to talk a little bit about reverse mortgages, mostly because totally misunderstood. Here we go. Let me say... perfect. So, number two, I'm comfortable. Anyone has a question, a burning thing that you want to ask me, fire away. Next is, we don't need to talk financial about Pacific, something to your own circumstance. Happy for you to call me up, arrange for a consultation to come into my office. So we're not going to drill down through the specifics of your house and your neighborhood, etc., because I understand as well as you that that's not something you want to talk about in a room of 20 people. But number one thing that we're going to talk about, we start with the principle that staying in your own home is your optimum goal. 93% of Canadians surveyed by Ipsos Reads basically say that is an objective that you have. Maybe it is for you, maybe it isn't, but 93% of people over 65 years of age say that staying in their own home is a priority. However, unfortunately, only 78% of people have savings. Worse than that, 40% of those 78% have less than $100,000 in savings. So therefore, they end up in a position where they're relying on their home prices for the retirement. The Ontario Securities Commission did a study, and literally 40% of Canadians, or 40% of Ontarians, are relying on their home as a retirement. So therefore, in summary, some seniors find themselves, or some retirees find themselves house rich and cash poor. What are some of the things that are done about that? Of course, you know and I know we face unexpected financial challenges, whether it's aging parents, whether it is adult children at home, whether it's, in fact, it's kind of interesting that there is now a substantial number of Canadian families have adult children into their 30s staying at home. That is a phenomenal. That's totally different than when most of us left home at 16 and 17. So this kind of thing is facing retirees, and therefore there's a higher level of financial pressure on people over 55 and into the retirement age. It's kind of interesting. Equifax is the people that keep credit information in Canada, and the demographic that has, the only demographic in the last year that's had declining credit quality is actually people 65 and over, which is somewhat unfortunate. What are some people doing it? I've recorded there in your presentation, a copy of your presentation, how much consumer debt seniors actually have in retirement, in other words, after they've retired. But there's also a trend for delayed retirement where it's moved up from 30% to 39% for men and 15% to 28% for women that are staying in the workforce between 1997 and 2010. And as we all know, you will know people that are still working into their 70s. And although they say they want to, I often question whether it's because of financial necessity. We're seeing some trends about, and when asked Canadians what they believe the amount they needed for a full retirement would be, the average Canadian said $756,000 was needed for retirement. That doesn't mean that's the number is needed. It was when asked average Canadians, that's the number that they gave was the amount that they needed in retirement. It is probably given as a financial amount separate from their home because not everybody sees. We'll talk a little bit about alternatives for accessing equity within your home. And in addition, some people are actually selling their home and leasing it back from the person that they've sold it to. And of course, we've talked a little bit about it. This generation, living to the time that it has, is truly now becoming that sandwich generation. We have our parents that are into their 90s, and some even a little later, but we have these adult children. So all of a sudden, we have the financial pressures of our family, our parents, and in many cases, we have the financial pressure of our children that haven't made it out into the world. And we've even seen some examples where I read this article literally last night about a woman that her husband had passed away, and every time the house creaked or the wind blew, she was awake at night. And we're now seeing lots of examples of intergenerational home sharing. What she actually did was started taking in foreign students as much because she wanted to have company, but also that person that became the younger person that was coming into her home had no opportunity to get a similar type of house and was prepared to trade, helping with groceries, shoveling the sidewalk, those kinds of things. But what I'm just talking about is examples of how retirement is changing for this generation since 2000. And these are just some examples, some of which you will resonate with, others that your friends resonate with. Now, this is just a list of the things that people use financing for. Everything from paying debt, helping kids with your education, home renovations, improve your lifestyle, monthly living expenses, healthcare example, in-home healthcare, medical expenses, home repairs. These are just a list of all of the kinds of things that people can use financing for. And there's nothing particularly individual about this, but it's just kind of interesting that we talk about living inheritances. Therefore, the amount of money that parents have been passing on to their children. So the average amount that parents are passing on to their kids, and I hate when I look at this number because my own kids think I'm cheap, but it's between $25,000 and $50,000 that families are passing on to their adult children. And the median age that they're passing that on is at over 30, so between 30 and 34. So we're going to talk specifically here about three types of financing for mortgages in retirement. Number one is a conventional mortgage, based on credit rating, income, and property. That's a traditional mortgage, no different than a mortgage you would qualify in your working years at 35 or 40 years of age. Number two, home equity line of credit, or referred to commonly as a HELOC, but it is basically a line of credit or financing based on your home. So you qualify on an income and credit rating. It's obviously available from multiple banks and credit unions, but the difference between that and a conventional mortgage is a HELOC. Say you had a limit of $50,000 and you paid the line of credit down to $40,000, you can generally re-borrow up to the $50,000 limit. So it's what is often referred to as a revolving line of credit, or a line of credit that can go up and down based on your demands secured by your property. And then we have the area of equity financing, and it's based on the value of your home. So you are not income qualifying, and many pensioners, like you may have a small corporate pension, but you'll have a Canada Pension Plan, OAS, and in some cases GIS. Well, these types of income usually will not be enough to qualify for a traditional mortgage, but many people will own their own home outright, so they will qualify on the value of the home. And obviously you're qualifying on the age and the value of your home. Reverse mortgages is a common product in this area, and above reverse mortgages, some people actually access private lenders, and private lenders, the interest rate is much higher. So we're going to talk a little bit about reverse mortgages specifically. I can challenge you today, if you go and Google reverse mortgages, 80% of the stories that you will find are US based. Reverse mortgages are given a bad name mostly because of what's happened south of the border. We have a regulated banking industry, and reverse mortgages are regulated with those Canadian banks, Home Equity Bank and Equitable Bank, just the same way as Scotiabank or Bank of Montreal are regulated. No difference between their regulation. It's regulated by an organization in Canada called OSFI, which is the Office of the Superintendent of Financial Institutions. What is a reverse mortgage? It's a loan, no different than any other mortgage. The loan is secured by your property. The interest charged on a loan is compounded semi-annual, so there's interest that's compounded on a semi-annual basis. And the homeowner maintains ownership of the home and title of the home as long as the insurance and taxes are paid on that home. What are the differences? The borrower must be over 55 years of age. And both or all people on title to the mortgage must be over 55 years of age. And the mortgage is based on the qualification of the youngest of those two people. No principal is required to be paid until you sell the home. And interest can be paid, however, you are not required to pay the interest until the property is sold and you have moved out of the property. Believe it or not, with Canadian Home Equity Bank, there was 70,000 inquiries for reverse mortgages with Home Equity Bank last year in 2017. The next biggest principle, when you take out a reverse mortgage, you will never owe more than the property is worth. I am always asked this question about a catastrophic fall in the value of the home. So to give you an example, if for say home values are today, so the property is worth $1 million today, or let's just use that as a round number, but property values go down to $400,000, and you took a reverse mortgage out and received $550,000 on that property. Even though the home is worth $450,000 today, you would never owe more, you would never have to pay back any more than what the home sold for. So even though you've taken out a mortgage at $550,000, but the home is worth $450,000 when it goes to be sold, you would not owe any more than the $450,000. Notwithstanding, that has happened in equity banks, Canadian equity banks' history of over 30 years, less than 1% of the time. So, who's interested in a reverse mortgage? Both spouses must be over 55. They must own their home. Home must be their primary residence. You need to have a valid and adequate fire insurance. Property taxes paid annually. And the average age for a person taking out a reverse mortgage, believe it or not, is 72. So it's not necessarily a person that's 55, although it can be, but the average age of a person actually making the application at Home Equity Bank has been 72. Some of the benefits. Regular payments are not required until you or your spouse no longer live in the home. Interest is basically deferred. There is no real value to paying the principal on the mortgage. If you wish to pay it, you could. There is sometimes a value in paying the interest because then the interest compounds and the value of the amount of the mortgage is increasing on a compounded basis with the increase of the actual interest. The number is up to 55%. There's obviously a sliding scale. To give you an example, and I'm just using these as extremes, a home in Moore Park in Toronto is going to garner more money than a condominium in Scarborough. A person that is 80 years of age is going to get a higher level than a person 55 years of age. So it's based on a sliding scale. The amount, and I obviously have a calculator, and it's based on the appraisal amount of the home. Two requirements outside of paying your fire insurance and paying your property taxes, which are required anyway, is a home must have a property inspection. In addition to paying for the inspection, there must be an appraisal done on the home. In addition, John spoke a little bit earlier about capacity. This product requires that a person have an independent legal advice, and for all of the reasons surrounding capacity, the potential of making a decision against the person's consciousness or property value, independent legal advice is required. So therefore, we make sure it happens, but the lenders make sure that all borrowers get independent legal advice. And that's independent legal advice outside of the registration of the property, etc. No medical checks. You receive the money tax-free because it's against your property, so there's no reason for taxation. It does not affect in any way any payments on CPP, OAS, or GIS. And if somebody moves into a nursing home, and it was within the first 5 years of the mortgage, then fees are reduced by 50%. And if somebody passes, there's no fees on the closing out, therefore the sale of the property and closing out of the mortgage. There's two different ways to deal with a reverse mortgage. You can receive your money on a one-time basis, or you can receive it on an income basis. Basically, the minimum amount for a reverse mortgage is $25,000, so your 55% has to be $25,000. Or the minimum amount on a monthly basis has to be $8,000, or you can receive money on a quarterly basis, which is $3,000 per quarter. Some people look at this because they want to see it as a supplement to their income. And if you use it as a supplement to your income, then of course you're only paying interest, or the interest is only compounded when you actually receive the money. The interest, we'll get to that, but it has specific rates. But the rates are generally about 2%, 2.5% higher than what a conventional mortgage rate is. But remember, you're not paying the principal. You don't have to pay the interest, and the mortgage is qualifying on an equity basis. But if you were to look as a private alternative, or in some cases, people are using credit cards as a way to supplement their financing. A credit card interest rate is 18 or 19%, and a private mortgage is going to be up around, could be up as high as 10%.
Since you're not making any payments, what is the charge that's registered on title?
The full amount of the mortgage plus compounded interest.
Who determines actually how many years that compounded interest goes for?
As long as you live in the home.
That's an indeterminate amount. So how do you get a fixed charge registered on title? That's principal plus compounded interest that hasn't been paid.
So, do I know the legal question of how that title is actually registered? No, but I do know that the interest is compounded, and the compounded interest is part of the charge. But that home will never be, you will never owe more than that home is sold for. And in 85% of the cases, when a home is sold, there's equity remaining for the title owners of the property.
Can you get out of it at one time when you want to sell the house?
Absolutely. You can sell the house, but it would be very similar to traditional mortgages. It's a reducing fee schedule after 3 or 5 years, three or 5 years of having the mortgage. So, if you take out a fixed 5-year mortgage today and you want to sell your property in 3 years, it would be a penalty. Same thing here. But after the 5th year, there is no penalties.
Or let's say you win the lottery and you pay it off. You can do that too.
Absolutely. But if it's within 3 years, if it's within 3 years of taking out the mortgage, it would be a penalty the same way a traditional mortgage would have been. But after 5 years, there would be no penalties. We're starting to get into a little bit of the characteristics of both the reverse mortgage as well as the income, but the time has come on and people are starting to ask some questions. So let me open it up for any clarification or any further questions that you would have about the characteristics of this product.
Gerald, back to Glenn's question. So if I have a house that's worth $600,000 who determines whether it's like 5 years interest or 10 years interest?
Oh, no, it's accumulated, it's compounded on a semi-annual basis, on a time basis. In other words, the interest is not added on in the beginning. The interest is only compounded semi-annually as you go through the life of the mortgage.
So it's a $300,000 registered mortgage on the property.
Today.
And when the property sells, they say you owe another $100,000 in interest as of this day.
Which is compounded on a semi-annual basis, just the way a traditional mortgage is compounded.
Okay.
So no calculation upfront of future interest, no.
Okay, good. That's what it was.
I don't know this for sure, but my guess would be that the mortgage would be registered for the appraised value of the property. And then the amount you owe would be the principal and accrued interest at the time it's paid out.
Correct. The legal part of how it's actually registered on title, that actual, how the parcel registry actually occurs, that's what the lawyer did.
Because the lender's going to want it registered for certain to cover their investment.
Absolutely.
So they will want a large enough amount registered to cover the principal and all accrued interest. So I suspect it would probably be the value of the property at the time they register it, so they're always covered.
But notwithstanding that, what was the question? Notwithstanding that, the title is still maintained in your name, and you only owe the principal amount plus the compounded interest up until the point in time in which you've sold the home.
Does the interest rate change after 5 years?
Yes, it's a term of 5 years. There's the actual interest rate, so you can do variable. You can do a 5-year variable. You can do term 6 months, 1 year, 3 years, 5 years. Same types of decisions you would make with your financial advisor or your mortgage advisor when you're taking out the mortgage.
Do you get annual statements or so relating to this, or how much you're owing on the compounded interest?
Yeah, no, a statement would be available to you.
I mean, does it come out to you, or do you have to ask for it?
I have to get back to you on that. I've not seen the actual administration coming to the clients because I wouldn't get a copy of that. We represent, this is one of 10 areas of mortgage financing that I do. Everything from investment real estate, commercial to residential. We represent at Mortgage Wellness over 70 different lenders in various products. This is just one of those areas with obviously 2 lenders for reverse mortgages, but on home equity lines of credit, 4 or 5 different lenders that are in that space. Any other questions?
Gerald, why? So it's only the 5 major Canadian banks that do reverse mortgages, is that it?
No. The only 2 Canadian banks are Home Equity Bank and Equitable Bank in Canada. None of the 5 major banks participate in this space.
Or credit unions.
Or credit unions.
Why is that?
Competitive choice. They've just chosen not to be in the space.
The 2 that you mentioned, I'm never even heard of.
Well, Home Equity Bank has been in the space for 30 years. They're regulated by the Office of the Superintendent of Financial Institutions. They're a Schedule I Canadian bank, but they don't take deposits, so therefore they're...
I don't have branches.
Oh, no, they don't have branches. An Equitable Bank is a very traditional bank. They do other lending areas, but Home Equity Bank is focused totally on the seniors market and have been for its 30 years of existence.
How many people in Ontario would have a reverse mortgage?
Well, like I said, 70,000 people across Canada applied and or discussed this financing option last year. Specifically, to have the actual amounts of loans outstanding at Home Equity Bank, I can get it, but I don't have it at my fingertips. That would be kind of inundating people with big numbers, and that wasn't my purpose.
No problem. Yeah, thank you.
What's the
process is slightly different. They go up to 45%. Their minimums are a little higher. Their fees, this processing fee of $17.95, that's a little lower at Equitable Bank. But the differences between the two, it's really just competitive. There's just nuanced differences between the two. They're not major differences. But the big difference is Home Equity Bank will end up to 55%, where these Equitable Bank will do 45%, and the minimums at Equitable Bank are a little higher. They require a minimum mortgage of like $150,000.
Gerald, are you an agent for the two banks? Like if someone wanted to get a reverse mortgage, could they go through you to do the application?
Absolutely. I'm a certified reverse mortgage specialist, but specifically I'm regulated by the Financial Services Commission of Ontario. So my business is a regulated business for consumer protection. Notwithstanding, I've been in the financing space for over 40 years. I spent a 30-year career at Scotia, and my business rests on my own integrity.
Make sure everybody picks up the card.
But that specific information to this presentation is in the folders. There's some in there, some have picked up. So there's that presentation and a little more detail is there. In addition, there's a Home Equity Bank brochure there, my own card. I have a website that I write articles. You may have seen some of my articles that I've written in Georgian Life on various aspects of mortgage financing. In addition, my commitment to my clients is treat every mortgage like it's my own. So that is what I stand behind, and I run a very transparent operation, and I would not allow a client to be in a product or take a solution that they did not understand. In addition, consumer protection for this product is such that they ensure that, one, you're getting independent legal advice, and not all, but yes, the majority of what you read negative about this product comes out of the United States, and it's basically just a traditional equity financing. Yes, the interest rates are a little higher, but that's because you're not paying the principal and you're not paying interest, and it's just based on the equity of your home. You qualify on the equity of your home versus qualifying on an income basis. And other than that, I'm here afterwards, happy to take any questions and happy to take your phone calls and come into my office. My office is over the top of the liquor store right across the hall from RBC, and I also have an office in Toronto and one in Owen Sound, and I'm happy to sit down and have a conversation, even if it's just a consultation to hear you out and for you to ask questions of how it may or may not apply to you and your family.
Is the Equitable mortgage associated or a branch of Equitable Life Insurance?
Corporate ownership, I'm not absolutely sure. Equitable Bank is a separate organization from Equitable Life. I'm not sure if there's cross corporate ownership specifically. I could find that out.
Equitable Bank, is that listed on the Toronto Stock Exchange?
As far as I understand it is. And it definitely is a Schedule I bank in Canada, and it's regulated by OSFI. No different in their regulations. These two banks, the regulation is no different than a Scotia Bank, a Bank of Montreal, or a Royal Bank.
The office of the liquor store is a good position.
In actual fact, you like this. My new expression in opening up the business here, I'd much rather be looking over the bay than looking over Bay Street. So my actual office looks north and I look out over the water. So that's the part I'm enjoying. Thank you very much.